The COMEX has 70 million ounces of registered gold left in its vaults as of April 2026. To put that number in perspective, that represents roughly 2,177 metric tons of physical gold available for immediate delivery against futures contracts. At current gold prices of approximately $5,100 per ounce, that inventory is worth $357 billion. It sounds like a massive number until one understands what it actually represents in the context of the global gold market and the paper claims against it. Most investors see those numbers and think the system is fine. Ray Dalio sees those numbers and recognizes the exact configuration that preceded every major precious metals delivery crisis in modern financial history. But the real story is not that COMEX inventories are low. The real story is why they are low, what mechanism is draining them at an accelerating rate, and what every investor who owns paper gold, physical gold, or dollar-denominated assets needs to understand before the gap between paper gold and physical gold becomes undeniable. What has been observed over 40 years of watching precious metals markets operate across every monetary crisis in modern history is that COMEX registered inventory levels are not a random fluctuation. They are a signal, and when that signal reaches the levels being observed in April 2026, the mechanism that follows has never failed to produce a violent repricing in the physical market that leaves paper market participants completely unprepared. Here is exactly what is happening and why the 70 million ounce number is the most important precious metals market indicator being published right now. At the close of trading on April 3, 2026, COMEX reported 70.2 million ounces of registered gold in approved vaults. Registered gold is gold that has been allocated for delivery against futures contracts. It is the actual physical metal that stands behind the paper claims being traded on the exchange. That 70.2 million ounces represents a decline of 64% from the peak registered inventory of 196 million ounces recorded in May 2020. The decline has not been gradual. It has been accelerating. In the first quarter of 2026 alone, registered COMEX gold inventory fell by 18 million ounces. That is a 20% decline in 90 days. At that rate of drainage, the registered inventory reaches zero in 350 days. Not in a decade, not in 5 years. In less than 1 year from today, here is where things get important. The number being watched is not just the 70 million ounces. The number being watched is 0.3%. That is the percentage of open interest in COMEX gold futures that is actually standing for delivery. In a normal functioning paper gold market, the percentage of contracts that demand physical delivery ranges from 0.1% to 0.5%. The current rate of 0.3% is within that historical range, which is why mainstream financial commentary is not alarmed. But here is what that percentage obscures. Total COMEX gold futures open interest as of April 2026 stands at approximately 500,000 contracts. Each contract represents 100 troy ounces of gold. That is 50 million ounces of notional gold claims. If just 2% of those contracts, not 100%, not 50%, just 2%, were to stand for delivery simultaneously, they would demand 1 million ounces. COMEX registered inventory could absorb that, but if 10% stood for delivery, they would demand 5 million ounces. If 20% stood for delivery, they would demand 10 million ounces. The system functions as long as almost nobody asks for the metal. The moment a meaningful percentage asks, the arithmetic changes completely. And what is being observed in April 2026 is the early stage of that shift. The percentage standing for delivery is rising, not dramatically, not in a way that triggers mainstream alarm, but measurably. And in a market where leverage ratios matter, measurable is enough. Let me walk through the mechanism step by step, because understanding this mechanism is the difference between being positioned for what comes next and being liquidated when it arrives. Step 1. Gold futures contracts on COMEX trade at massive leverage. An investor can control $500,000 worth of gold with roughly $25,000 in margin, a leverage ratio of 20 to 1. For decades, this system worked because almost nobody actually wanted the gold. They wanted exposure to the price. They traded the contract. They closed the position before delivery. The exchange provided liquidity. Everyone was happy. Step 2. In 2022, something changed. Central banks, which had been net sellers of gold for 2 decades, became net buyers. In 2022, they purchased 1,037 tons. In 2023, 1,037 tons. In 2024, 1,045 tons. In 2025, 863 tons. 4 consecutive years of buying at more than double the historical average. Those purchases were not made on COMEX. They were made in the physical market, directly from mines, from refiners, from sovereign reserves. But every ounce purchased in the physical market is one less ounce available to back the paper claims on COMEX. Step 3. Simultaneously, investors who had traditionally held paper gold through ETFs began demanding physical delivery. In January 2026, a single bullion bank reportedly had to source 15 tons of physical gold in less than 48 hours to meet redemption requests from a sovereign wealth fund that had decided it no longer trusted the paper claim. The gold was found. The delivery was made. But the episode revealed the fragility of a system where the metal supposedly backing the paper is not always immediately available. Step 4. Lease rates exploded. The lease rate is the interest rate charged to borrow physical gold. In normal market conditions, lease rates range from 0.1% to 0.3% annually. In March 2026, one-month gold lease rates spiked to 4.2%, the highest level recorded since the 1999 gold carry trade unwinding. A 4.2% lease rate means someone is paying 4.2% annually to borrow gold for 30 days. That is not normal. That is stress. That is a signal that physical gold is not readily available at the price the paper market is quoting. Step 5. The Shanghai Gold Exchange premium widened. Physical gold in Shanghai has been trading at a $15 to $22 per ounce premium over COMEX paper gold prices throughout March and early April 2026. That premium means buyers in Asia are willing to pay $15 to $22 more per ounce for physical metal than the price quoted on the New York Paper Exchange. That is not a transportation cost. That is a scarcity signal. The physical market is pricing in a reality that the paper market refuses to acknowledge. Step 6. The derivative chain nobody is calculating. Behind the visible COMEX futures market sits a largely opaque over-the-counter derivatives market, where bullion banks write gold swaps, options, and forwards for institutional clients. The Bank for International Settlements estimated total notional gold derivatives outstanding at approximately $450 billion as of December 2025. That notional value represents claims on gold that exist entirely outside the COMEX registered inventory system. When stress emerges in the futures market, it transmits directly into the OTC derivatives book. Banks that sold gold call options to hedge funds suddenly need to hedge their exposure by buying futures or physical metal. That buying pressure adds to delivery demand precisely when registered inventory is tightest. The derivative tail begins wagging the physical dog. What appears as a simple inventory drawdown on COMEX is actually the visible tip of a leverage pyramid where each ounce of physical gold supports multiple layers of synthetic exposure across futures, options, ETFs, and OTC derivatives simultaneously. What makes this premium structurally significant is its persistence. In normal market conditions, arbitrage traders would exploit the spread by buying on COMEX and selling in Shanghai, pocketing the difference until the premium collapses. That mechanism is not functioning. Why? Because the metal purchased on COMEX cannot be physically extracted and transported fast enough to meet Shanghai demand. The refiners are backed up. The vaults are slow to release. The logistics chain that should connect the two markets is constrained. That constraint is the physical bottleneck that paper markets cannot arbitrage away. And here is where the real story begins. Because the 70 million ounces of registered COMEX gold is not the whole picture. There is a second category called eligible gold. Eligible gold is gold sitting in COMEX-approved vaults that is owned by investors, institutions, and sovereign entities but is not currently allocated for delivery against futures contracts. As of April 2026, eligible COMEX gold inventory stands at approximately 240 million ounces. Most analysts who are not alarmed by the 70 million ounce registered figure point to the 240 million ounces of eligible gold and say the system has plenty of metal. If registered inventory runs low, eligible gold can be converted to registered status with a few keystrokes and a warrant transfer. The system is fine. Here is what that analysis misses. Eligible gold is not COMEX's gold. It is someone else's gold that happens to be stored in a COMEX-approved vault. The owner of that gold chose not to make it available for delivery. And the assumption that eligible gold will smoothly convert to registered gold the moment COMEX needs it is an assumption that has never been tested under genuine stress. What happens when the owners of that 240 million ounces of eligible gold decide they do not want to convert it? What happens when they conclude that the paper market is mispricing gold by $15, $50, $200 per ounce, and they would rather hold the physical metal than exchange it for a paper claim at the COMEX price? That scenario is not theoretical. It is happening right now in smaller scale. Reports from bullion dealers in March 2026 indicated that sovereign buyers and family offices were offering premiums of $10 to $30 per ounce above spot price for immediate physical delivery of large bars. They were not buying on COMEX. They were bypassing COMEX entirely and going directly to refiners, to mints, to other sovereign holders because they assessed that the COMEX paper price was not reflecting the true market clearing price for physical metal. Layer 1, the February 2026 delivery spike that nobody covered. In February 2026, COMEX gold futures saw an unusual surge in delivery requests. Approximately 8.2 million ounces stood for delivery in a single month, the highest monthly delivery total since August 2020. The metal was delivered. COMEX did not default. The system functioned, but registered inventory fell sharply from 88 million ounces at the start of February to 74 million ounces by the end of the month, a 16% decline in 28 days. What made that delivery surge significant was not the volume. COMEX had handled larger deliveries before. What made it significant was the profile of the entities taking delivery. These were not retail investors. These were institutional players, sovereign-linked entities, and bullion banks acting on behalf of clients who were converting paper claims into physical metal and removing that metal from the COMEX system entirely. Once metal is withdrawn from COMEX vaults, it does not typically return. It goes into sovereign reserves, into private vaults, into allocated storage accounts where it sits outside the fractional reserve system that COMEX operates on. Layer 2, the March 2026 margin hike that revealed COMEX's concern. On March 12, 2026, CME Group, which operates COMEX, raised initial margin requirements for gold futures from $9,500 per contract to $11,200 per contract, an 18% increase. They raised maintenance margin from $7,800 to $9,200, also 18%. The official explanation was standard risk management in response to increased price volatility. Gold had been moving more than $100 per day with increasing frequency, and exchanges routinely adjust margins when volatility rises. But anyone who has watched COMEX operate over multiple decades recognizes margin hikes for what they often are, a tool to reduce speculative long positioning when the exchange is concerned about the gap between paper claims and physical availability. Raising margins forces leveraged traders to either post more capital or close their positions. The effect is to reduce open interest and reduce the potential future delivery demand without COMEX having to admit there is a supply concern. The March 12th margin hike reduced COMEX gold open interest by 7% over the following 2 weeks. Approximately 35,000 contracts were closed. That is 3.5 million ounces of notional gold exposure that exited the system, not because those investors changed their view on gold, but because they could not afford the higher margin requirement. For COMEX, that was 3.5 million ounces of potential future delivery demand that disappeared. Layer 3, the Asian gold vault build that Western media is not covering. While COMEX registered inventory has been declining at an accelerating rate, a parallel development has been unfolding in Asia. The Shanghai Gold Exchange reported in March 2026 that vault capacity in China had increased by 1,200 tons over the past 18 months. That is not 1,200 tons of gold. That is 1,200 tons of new storage capacity, representing infrastructure being built to hold physical gold that is being accumulated and withdrawn from Western exchanges. Simultaneously, Singapore, which has positioned itself as a gold trading hub for Southeast Asia and the Middle East, reported record gold imports in Q1 2026. Over 250 tons of gold flowed into Singapore in the first 3 months of the year, the highest quarterly total in the city-state's history. That gold is not being re-exported. It is being stored in allocated accounts, in sovereign vaults, in private storage facilities that are outside the COMEX and LBMA fractional reserve system. What is being observed is a geographic shift in where physical gold is being held. It is moving from west to east. It is moving from paper-backed ETF claims to allocated physical storage, and it is moving at a rate that is draining COMEX registered inventory faster than new supply can replace it. Here is what is actually being watched by those who understand the mechanism. Not the 70 million ounces, not the daily price. Two numbers. Number one, the coverage ratio. That is registered COMEX gold divided by total open interest in futures contracts. As of April 2026, the coverage ratio is 1.4 to 1. That means for every ounce of registered gold in COMEX vaults, there are 1.4 ounces of paper claims against it. In a normal market, the coverage ratio ranges from 3 to 1 to 6 to 1. At 1.4 to 1, COMEX is running the tightest coverage ratio in its modern history. Number two, the delivery acceleration rate. In 2023, total annual COMEX gold deliveries were 24 million ounces. In 2024, they were 31 million ounces. In 2025, they were 42 million ounces. The trend is clear. Every year, more contracts are standing for delivery. Every year, more metal is being removed from the system, and the registered inventory available to meet that demand is declining. If the current trajectory continues, and there is no mathematical reason to expect it will not, COMEX registered gold inventory reaches a level where a single large delivery request, say 10 million ounces, would represent more than 14% of total registered inventory. At that point, COMEX faces a choice. Deliver the metal and watch registered inventory crater to levels that make the system's fragility undeniable. Or invoke force majeure, cash settle the contracts, and admit that the paper market cannot deliver the physical metal it claims to represent. That is the scenario Ray Dalio has been describing in his public assessments, not as a prediction, as a mathematical outcome that becomes increasingly probable as the coverage ratio tightens and the delivery demand accelerates. Here is what makes April 2026 different from every previous period of low COMEX inventory. The stress is not isolated to gold. It is appearing simultaneously across silver, across platinum, across palladium. COMEX registered silver inventory has declined 62% from its 2020 peak. Lease rates for silver spiked to 8% in January 2026 before the March crash brought them back down. The physical premium for silver in Asian markets has been running $2 to $4 per ounce above COMEX paper prices. The entire precious metals complex is exhibiting the same pattern: declining registered inventory, rising lease rates, widening physical premiums, and accelerating delivery requests. That is not a coincidence. That is a systemic signal. It is the signal that the fractional reserve structure that has governed precious metals pricing for 50 years is being tested at every stress point simultaneously. The most dangerous assumption an investor can make right now is that COMEX will smoothly handle this transition. The exchange has tools. It can raise margins further. It can impose position limits. It can force cash settlement. It can halt trading. It can change the rules, as it did with the Hunt brothers in 1980, when it made silver contracts liquidation only. But every one of those tools is a public admission that the paper market cannot deliver what it claims to represent. And that admission, when it comes, will reprice gold faster and more violently than any gradual inventory decline. The investors who are positioned for that repricing are not the ones holding leveraged paper gold ETFs. They are not the ones trading COMEX futures with 20 to 1 leverage. They are the ones holding physical metal in allocated storage, outside the COMEX system, outside the fractional reserve mechanism, in jurisdictions where their metal cannot be hypothecated, leased, or claimed by multiple parties simultaneously. This is not a gold price story. This is a story about the difference between a claim on gold and possession of gold. And what the 70 million ounce registered inventory number reveals is that the gap between those two things is narrowing to the point where the system that has treated them as equivalent for 50 years may no longer be able to maintain that fiction. In 40 years of watching precious metals markets, the pattern has been consistent. Paper and physical prices diverge during stress. The divergence widens. Authorities dismiss it. The divergence continues. And then the paper market reprices violently to meet the physical market, because the physical market is the market that actually clears. The paper market is the market that provides leverage and liquidity until it cannot. COMEX registered inventory at 70 million ounces and falling is not the crisis. It is the warning that the crisis is approaching. Most investors will not recognize it until the repricing has already occurred. Now the information is available. What is done with that information determines who benefits from the mechanism and who gets caught on the wrong side of it when it resolves.